All right, welcome to class, everyone. That's right. Here you thought you'd never have to be in a classroom again, but in walks the PSP and SMS benefits plans for executives at DHL. An executive benefits plan which at first glance seemingly requires a prerequisite suite of advanced college courses in finance just to get started in terms of trying to comprehend what it all means. So I'm Adam Koós, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group right here in Columbus, Ohio. I recorded this video, or we decided to record this video, because we had a couple clients who came on board, and when they handed us the benefits package for DHL, particularly the PSP and SMS packages, it was so unbelievably complicated that in my 21 and a half years now, I've been doing this, and I've never seen a retirement plan package that was more complicated. So naturally, being the nerd that I am, I got really excited, took it on as a big challenge, and decided I wanted to research it and try to figure out how this works, and so we could put something together for these clients that we work with so they would understand it better. And then as we finished it up, it was at the recommendation of those clients that we work with now that we kind of create this video and pass it on. So provide some free education and maybe clear up these muddy waters that make this benefits package so complicated and hard to understand. So as I go through it, there's a lot of information here I want you to understand. I'm probably going to bounce around just a little bit, maybe go back and forth if it seems to make sense to do so. But just understand that if you have any questions, you can email us afterward, after you watch it. Of course, you can always pause, rewind, rewatch if you'd like. But if you have any questions about your personal situation, your personal benefits package, even if you're looking for a second opinion on your retirement plan in general, just know that we're here for you and we're happy to help with no obligation and no costs. So just as a service to our current clients that are working with us, that gave us this opportunity. So with that all being said, what you're about to see is a presentation that I built based on 12 hours of research, including at least 2 hours of time on the phone with HR at DHL. So all of this information is accurate as of the end of 2022, beginning of 2023, and I will be looking up to update it at least once a year, and if there's major updates that need to be made, then we will re-record a new video at that time. So without further ado, let's go ahead and jump into it. I'm going to turn off my face here so you can see all the information a whole lot easier, but we're going to talk about this in two sections. The first is the Performance Share Plan, or PSP for short. And as I go through this, I want you to understand that there's all these definitions we need to keep in mind. So for instance, PSU stands for Performance Share Unit. And each performance share unit is equivalent to 1 share. So as long as we can get that behind us, because this already starts to get a whole lot easier. So all the acronyms obviously get confusing. All of the shares are stored at Equate Plus, and the vesting period is 4 years. So it has to stay there for 4 years. They are serviced by company shares. In other words, when they vest, you get company shares of DHL if one or more of 6 what are called hurdles are met. And this is where it starts to get a little confusing. There are 4 absolute hurdles and 2 relative hurdles, which we'll get into a little bit more later on. But let's just start by saying that there's 6 hurdles and that these shares can be sold at any time after they vest. Again, that's 4 years. Now, before we move on any further, in order for these shares to vest, in order for us to get any of our grants vested and then shares sold and serviced, we need to hit these hurdles. And when we hit these hurdles, the price that they're using is what's called a moving average. It's not the actual price of the stock or DHL, it's the price of the moving average of the stock. So before we move on any further, let's talk about what a moving average is. First and foremost here on the bottom on the left here, we can see this is a price, just a normal candlestick chart of the Europe Stocks 50 ETF. Now when we're comparing, when we get into the relative hurdles, what the DHL stock is being compared to is the Europe Stoxx 600 index. Now, this is the Europe Stocks 50 ETF, which is the top 50 stocks on the Europe Stocks 600 index. So it's not exactly the same. It's similar, but it's not exactly the same. I just want to make sure I disclose that right up front. But it's a good symbol to use for comparison, we'll just say. So when we look at this chart on the left, this is just a price chart. Every candlestick is 1 day, and that's what you're looking at here. So it goes back in this case to December September of 2021, and every little tick you see or candlestick you're looking at on the screen is 1 day. It can get kind of confusing because sometimes we got big up days, sometimes there's big gaps down, sometimes it kind of chops along sideways, but when determining whether or not your shares vest and are eligible to be serviced, what they're not looking at just price or the price of DHL stock on an absolute basis, and they're not looking at the price of DHL stock versus the Europe Stock 600 index on a price basis. They're looking at on a relative basis using what's called a moving average. So on the left is a price chart. On the right here, though, I've added what's called a 20-day moving average, and that's exactly what DHL uses in their benefits package to determine whether or not the shares vest and whether or not they're eligible to be serviced. So this blue line here, what it does is it basically creates a trend. As opposed to looking at every individual day and all the spiky kind of choppiness, it gets rid of that choppiness and it smooths things out. So when we talk about moving averages in the future, or if we're ever on the phone or through emails, whether it's with us here at our office or with the benefits department at DHL, your HR department, understand when they talk about a moving average, this is what they're referring to. So visually, I think it makes a whole lot more sense if you see it on paper. So let's move on. So again, after 4 years, and this is back to the moving average, if the 20-day moving average, and I abbreviate it as 20 MA, for future reference, but if the 20-day moving average is above the grant price, so the price at which the shares were granted to you, then the performance share units are serviced. Now, if the 20-day moving average is below the grant price, the vesting schedule can then be extended for up to 2 years or less if the price rises. So if we go on, if the shares are basically worthless, I guess I'll start there. If at the end of 6 years, so after 4 years, the shares vest, then we have another 2 years of extended vesting. If the stock price is still below the grant price, then the PSUs are deemed worthless. So again, if after that, within that 2-year period after vesting, so we go 4 years, we're vested, then we have an extended 2 years of vesting. If within that 2 years, the price, the 20-day moving average of the price gets above the grant price, then some of the shares would be then serviced to you, and that could be through the first absolute hurdle, or it could be one or both of the relative hurdles, which we'll get into in a second here. But just understand that when it says or less, it means you could wait longer if you want. So you don't have to service the shares immediately after the price rises, but you do have to execute the shares within that extended 2-year period. If you go beyond 2 years, again, the price is deemed worthless at that point. Trading has to take place within trading windows, or to use DHL's language, you cannot trade your shares within what are called no trading periods. I've always called them trading windows, so that's what I'll continue to call them, but just understand for the sake of semantics, that's what DHL calls them. Grant letters go out in the fourth quarter to let you know what was just granted to you on September 1st of the same year. And then from there, you'll see how many shares were allocated in your Equate Plus account. Just kind of looking at some administrative housekeeping there. Shares are always priced in euros, so just keep that in mind. And then when we talk about the grant price, so what is a grant price? Well, here's how that works. So let's just say back, I'm going to use 4 years. I'm recording this on December 21st of 2022. So just for the sake of conversation, I decided to use December 21st of 2018, so 4 years ago exactly. And I looked at that price, and ironically enough, the price when you look at the grant date of 12/21/18, the price at that point was $24.12. The way the grant price works with DHL is they immediately bake in a 30% increase to determine the floor for whether or not we're going to be above or below that grant price in the future, so 4 years out. So if the stock's granted at $24.12 on 12/21/18, then we add 30% to that, and the price is $31.36 per share. That's our floor. So that becomes basically the grant price. And from that point forward, I just drew a line here all the way out into the future. Once 4 years hit, which you can see here, 12/21 of 2022, the price, not the 20-day moving average, but the price on that day was 12/21 2022. If you're already kind of figuring this out, you could probably assume that the moving average is probably higher than price, because price fell pretty quickly here, it looks like, just in one day. So at any rate, in this example, 4 years out, then at least some of these shares would be serviced upon vesting, and again, in this example. If we go on to the stock ticker, DPW is the stock ticker used for the sake of tracking DHL's stock price, but it trades on the DAX, so the German Stock Exchange. So it's not going to be something that's really easy to find on all online quote monitors. I used Yahoo Finance because it was easy to find it there, and it's free to use Yahoo Finance. So if you want to check that out, that's finance.yahoo.com. And when shares are transferred, the receiving firm, just so you understand, can make transferring those shares very difficult. In other words, some firms cannot accept shares denominated in foreign currencies. So again, DHL is, and the symbol again, DPW, is traded on a foreign exchange. It's not traded in what's called ADRs, American Depository Receipts. So when the shares come over at vesting, some firms aren't going to accept those shares because it's not technically in U.S. dollars. So this is important. In the past, if this is implemented incorrectly, shares are then liquidated overseas, and then the ADR is repurchased again, which triggers a taxable event. Whereas what you want to have done is you want to have the shares transferred, not sold and repurchased. So this is crucial when it comes to tax planning. It doesn't matter if the cost basis is such that the entire purchase triggers long-term capital gains. And by the way, what I mean by cost basis is the total average cost paid for the shares, whether that be the grant or the total shares executed or serviced. But if there's still a portion of the shares that are within the 1-year window, you need to be mindful and include this as part of your tax planning discussion with a qualified tax professional, CPA, or so on, because you could be subject to short-term capital gains with a portion of those shares. So we want to, in order to qualify for long-term capital gains, as of tax laws right now, December 21st of 2022, shares need to be held for a full 12 months, 365 days after which they would qualify for long-term cap gains. However, again, there are situations where some shares may not qualify for long-term capital gains, and instead you would pay short-term capital gains, which would be taxed at your income rate. So this is all, again, all part of the equation here, not really having a whole lot to do with DHL's executive benefits plan specifically, but more along the arena of tax planning, and something you need to keep in mind when you're going through this process. So here are the hurdle illustrations that are available to you in your DHL PSP manual and Q&A booklet. And I'm not going to spend too much time going over these, because I feel like what I bullet point here and some of the charts I show you are going to make this make a whole lot more sense. But let's just fly through it briefly. So the grant granted to a selective executive is translated into a corresponding number of PSUs. We already talked about that. So performance share units, and that's on the date of the grant, or grant day. The PSUs are calculated on the basis of a 30% expected share increase from the grant price. So remember, we talked about that floor. I'll go back to it just briefly here. So here's the floor. This is 30. So we have the grant date here. The price at which the grant price is going to be calculated in the future is based on 30% above the price on that day. So that's what that means. If we, the number of PSUs that can be serviced, or that will be serviced, is dependent on the achievement of the performance hurdles that we'll talk about here in a second at the end of a 4-year vesting period. Again, vesting period's 4 years. And the value of company shares provided is limited to 3 times the grant value. That's also something we'll talk about later, but you can't get more than 3 times the grant value. So we get this bump in 30%, and then we have these 4 absolute hurdles where you can get up to 1/6 of the shares, 2/6, 3, or 4/6 of the shares serviced based on absolute return hurdles. Or, well, I should say, or you can also, as long as the grant price is above the 20-day moving average, as long as the 20-day moving average of DHL's stock price is above the grant price. I'll say that one more time. Again, 20-day moving average of the stock price, as long as it's above the grant price, the adjusted grant price, that 30% adjusted grant price, then if it's above that amount, then you can get some of those shares serviced to you. You might get a very small portion of them serviced to you on the absolute basis if it's just above the price. But if the DHL stock has outperformed the stocks Europe 600 index at 0 to 10%. So in other words, if the performance of DHL has been better than the stocks Europe 600 index up to 10%, then you would get an additional sixth of your shares serviced to you. If by chance DHL stock has outperformed the Europe stock 600 index by more than 10%, then you get both of those relative performance hurdles hit, and therefore you would get 3/6 or 1/2 of the shares serviced to you. So let's move on to my examples here. So here we have an explanation on the hurdles. Again, a growth rate of 30% over 4 years is already built into the performance share units as the initial hurdle. If the owner of the grants hits one of the 6 hurdles, they will get 1/6 of the total number of PSU shares granted at the end of the vesting period or after the shares vest. You can receive up to 4/6, or in other words, 2/3, of the shares via absolute performance hurdles, and this is how they look. So just again, I have all these pausing moments here. These are preset percentages that are used to determine the absolute performance hurdles. So in hurdle 1 is 10%, hurdle 2 is 15, 20, and then 25%. So those are the first 4 absolute performance hurdles, which these are based on the grant price, again, plus 30%, going out into the future into 4 years. And then again, if the stock price, the 20-day moving average of the stock price is above the grant price, including that 30% bump, then this is how those absolute performance hurdles are serviced. The relative hurdles, again, if you didn't catch this on the previous slide, this is how these work. Again, it's a relative hurdle because we're comparing the relative performance of DHL stock to the stock 600 index. So if the DHL stock outperforms stock 600 index between 0 and 10%, then you get another 1/6 of these shares serviced. If the DHL stock outperforms the stock 600 index by more than 10%, then you get another 1/6 of your shares serviced. So again, this initial 30% bump's already taken into account by the number of initial shares granted. So we can ignore on the picture on the previous slide, we can ignore that 130% in the illustration because the shares granted are net after this calculation. Just again, I think that's one of the things that made this initially so confusing. Again, as mentioned on their slide, there is an absolute maximum for those absolute hurdles. You can only receive up to 3 times the original grant price at the end. So if DHL stock goes to the moon and things are just absolutely kicking on all cylinders, there is a cap. Not that anybody would be all that upset about 3 times the price. Let's just keep that in mind. So here, this is also a slide that's inside your packet at DHL, and I think that's actually a pretty good one. So the way this works, if you can follow on with my mouse here we have an assumed grant of 27, priced in euros, all the way back here in September. This is an example of September of 2014. And what it says here is the stock goes up, it goes down, it kind of chops around, but ultimately, before it vests at 4 years, and this is 31st of August 2018, 4 years later, the stock price is down. So on the vesting date, the price is below the grant price, which means they would be deemed worthless, right? Now, what we can do, though, is we can have our vesting schedule then extended for another 2 years because we want the price to come back, of course. Because if the price comes back above the grant price, then at that point we can have some of our shares serviced. So here in this example, the price does not exceed the grant price. So we wait. The share price eventually does come back in this example. And after, in this example, 9 months or so of extended vesting period, 2 of the 6 PSUs are immediately serviced because we have an absolute performance trigger that's been hit and it's outperformed the market. Down here at the bottom it says has still outperformed the market and 2 of 2 relative hurdles have been met. So even if none of the absolute hurdles have been met, as long as the price, the 20-day moving average of price, gets above that grant price and 1 or 2 in this example of the hurdles, the relative hurdles have been hit where the DHL stock outperformed the stock 600 index, then you would get shares serviced. The scenario 2 here, the other example, is that the stock does not come back, unfortunately. Here, it just stays below the grant price until the end of the 2-year extended vesting period, and then at that point, the grants become worthless, unfortunately. But let's go into my example that I created here just to give you a second idea, or at least a second example of how these absolute hurdles work. So you've seen this chart before, but I added a couple notes to it. Again, let's just say hypothetically we are granted the stock back on 12/21 of 18, so 4 years ago. Again, you immediately bump up the price at 30%, which makes our floor $31.36 per share, and that's the floor throughout the vesting period. Once we get to 12/21 of 22, which is 4 years out, we're using the 20-day moving average of price, so we're not using price itself. Here's the price you can see is $35.27 when I recorded this video, but the 20-day moving average of price is actually higher. It's at $38.01. So the moving average, again, is the smoother line. And as you can see, the smoother line, the 20-day moving average, is above the grant floor, the grant price, which would mean that at least a partial number of our shares are eligible for vesting or servicing. So again, at vesting after 12/21/22, 20-day moving average of price is higher than 30% above the grant price, and that means our grant's eligible for at least partial vesting or servicing. So that's how the absolute hurdles work. And then again, we can go back, if you'd like to rewind and go back to the percentages, feel free to do that and check out the different percentages for each absolute hurdle. But let's talk now about the relative hurdle example. Let's get a visual on that so we can understand that better. What I'm looking at here is, again, this is the Spider Stocks Europe 50 ETF. So I want to disclose here again, this is not the Stock 600 index in Europe. This is the Spider Stocks Europe 50, so top 50 stocks on that index. So it's not going to be perfect, but for the sake of this tutorial and education, I think it does a good enough job. So the blue line, what we're looking at here, is price of DHL stock. Again, the smooth line is the 20-day moving average of DHL stock price. And then this line here in the bottom is the Spider Stocks Europe 50 ETF. And the way it would work is that as long as and I'll go back to the prior slide, as long as price, the 20-day moving average of price, was above the floor of your grant price plus 30%, so as long as we have that first rule hit, then we can not only look at the absolute hurdles, but we can look at whether or not the DHL stock has outperformed the stock 600. Again, this is in this example, the stock's 50. So in this example, I took 38.01, which is the, again, 20-day moving average price. This was intraday, by the way, not closing price, but intraday, minus 35.26, which is the price of the index. I get $2.75, or not dollars technically, it's euros, not dollars, but I take that, I divide it into 35.26 to get our performance, and our relative performance is 7.8. So what that means is that when you look at the 20-day moving average of DHL stock, it outperformed the stock's 50 index by 7.8%, or in other words, by less than 10%, which means that one of those relative hurdles were hit. Not both, but one of them. If it would have outperformed by more than 10%, which I cheated down here and put a little note for myself to say as long as it got up to, if the 20-day moving average of price was at 38.79 or higher, and you can see here it's 38.01, but if it were at 38.79 or higher, it would have been, you would have gotten both hurdles, so both performance hurdles, because you would have gotten one for it being an outperformer over the stock 600 for being up more than 0 but less than 10%, and then another for it being up more than 10% over the stocks index. Now, if the inverse were the case, let's just say, for instance, we can't use this because, again, vesting doesn't exist, but let's just say back here in 2019, you can see here the 20-day moving average of price, and price for that matter, are both below the stocks 50 in this example. So that obviously is an example of when it would not have outperformed. And if that's the case, then you would not get either of those relative performance hurdles. I hope that makes sense. So let's change gears here and talk about, for the PSPs, last topic, what happens if you leave the company. So what happens if you leave DHL? If you retired, and that's the reason you're leaving, is you retired during the normal vesting period, so within the vesting period, you're treated as if you're still an employee. So in other words, you can continue on with the vesting period. If you leave the company voluntarily during the vesting period, shares will not be serviced, however. So this is not retiring, this is just quitting. If you're retired and the price of the stock is below the value of the grant price, again, unfortunately, you're not going to be entitled to the additional 2-year vesting schedule offered to current active employees, and unfortunately, those shares would be deemed worthless. So you don't get that extra 2 years that current employees would get. And again, I just got a little pause moment here. Just some FYI, in that this is important. Not to say it would never happen, but while this is technically in the fine print, it's never happened before. So what do I mean by that? Does that mean that if you were retired and the price were below the grant price the day you retired, but it goes up a week afterward, would you be serviced those shares? Possibly. Is it in the fine print that you would not receive those shares if the price did not go up until after your retirement date? Yes, it's in the fine print that you would not get those shares if the price went back up above the grant price after you retire. So just keep that in mind. It's never happened before, but it doesn't mean it can't happen. To receive the shares at retirement, your age plus the years of service must equal 65 years or older. So as an example, if you're 58 years of age and you have 7 years of service, that equals 65, so you can receive your shares at retirement. And then if you're 65 with 1 year of service, it doesn't really make a difference because at 65 years of age, then you're eligible to receive the shares. All right, let's change gears here and start talking about the share matching scheme. I have no pictures, charts for this one. This is just going to be a bunch of information. Think of it like drinking out of a fire hose, unfortunately. But again, it's complicated, but let's try to make it as simple as possible. A quick overview first and foremost, you have to elect to participate. So you're not going to be automatically enrolled. You have to elect. Again, there is a 4-year holding period for any shares that you elect to purchase. Matching shares at the end, so this is the share matching scheme. That's what SMS stands for. So the matching shares you get are granted at the end of the holding period at a 1-for-1 match. You get 1 share for every share you hold as a match. You can invest between 1 to 50% of your bonus, or if you choose not to elect, you don't have to, so you don't have to invest any. And typically the bonus has been in excess of the target amount, and it can be up to 2 times. The window is 14 days to make this election, and it closes in the 3rd week of March. So another pausing moment here. There is obviously 14 days is not a lot of time. So there's not a lot of time to make this election between when the bonus info is received by you and when this election needs to be made. So make sure you're paying attention and make sure you don't miss out. Once you've elected to participate, the election is actioned the 1st week of April. That means you're officially involved and officially invested. And the bonus is denominated in U.S. dollars, but the shares are denominated in euros. So the exchange rate's going to matter here. So depending on what the exchange rate is between U.S. dollar and euros, it's not going to be a 1-for-1 purchase, if that makes sense. The only way to purchase shares today, and this is as of 2022 to 2023. Again, I'm recording this video on December 21st of 2022. So the only way to purchase shares today is through an after-tax purchase via your bonus. So just to clarify, this is non-qualified money. In other words, this is not a pre-tax or tax-deductible contribution like you would get in your 401k. This is after-tax. And then shares, when they're sold down the road, they're sold using what's called FIFO accounting, which means first in, first out. So the first thing that came into the account, the first deposit, is the first thing that's sold. And this is across both sources, by the way. I know we're talking about the SMS here, but this is also applicable to the PSP. The FIFO for both shares. SMS shares are not separated from PSP shares in your account. So when you look at your account at Equate Plus, you're going to see them both. And then also, because we're talking about taxes here, the FIFO accounting method, this needs to be kept in mind for capital gains treatment. So when we're doing tax planning and we're determining when to sell your shares, or when to sell which shares, I should say, we need to keep all of this in mind. Keeping going here, we've got the employer, DHL, reserves the right to pay matching shares in cash instead of shares. This applies to only certain jurisdictions where there's issues with holding the stock. It also might occur for special circumstances, for instance, if there's any divestation of the business. But again, kind of unofficial fine print here, this doesn't really usually happen, so keep that in mind. Anything affecting the stock, so stock splits. For instance, so if the stock splits and you get a higher number of shares for a lower price, or in the case of what's called a reverse split, which would mean you would get fewer shares for a higher price, everything will be adjusted for the share price and the number of shares you own, so you don't really lose anything, you don't really gain anything. It's just going to change the number of shares you own and the price. Same goes for spinoffs. Spinoffs are when A company spins off a portion of its business to a brand new company. It might get its own stock symbol. It might go private. But if it goes public and it's a new public company, then the price might be adjusted down, let's just say, for the DHL shares, and then you might receive some shares in the new company, or it would be adjusted in some other way. Again, special note here, it hasn't happened much in the past. But there could also be just a cash out instead of an adjustment. They might just pay out in cash or a partial cash distribution. In the case that there's ever not enough cash available to cover the tax liability via payroll or ACH, the company reserves the right to sell shares in order to comply with tax laws. This is called selling to cover, if you've seen that in your documentation in your booklet. Again, find kind of an unofficial note here, this almost never takes place because what they're normally doing is they're just paying from future payroll runs. So an algorithm's used across the country for tax liability. And then what they're doing is they're passing against, it's called sell to cover. So they're passing the sell to cover proceeds and they're pushing it through a live check, which then calculates the employee's actual tax liability and compares it to the sell to cover. So if, for instance, if there's too much, then the employee's going to get back a little bit of money in their check. If it's not enough, then they might take it over the next 1 pay period, 2 pay periods, or so on and so forth. So that's honestly probably way too much information, but that's some of the details on how it works when shares are sold and calculated. But in a perfect world, they don't want to sell shares, and there's a number of reasons for that. They don't want to sell to cover because when you end up with a lot of selling to cover, it puts downside pressure on the stock. It creates trading issues when it comes to actual trading the stock and manipulating the price. And it wouldn't be intentionally manipulated by any stretch of the imagination, but it could affect the price if they have to sell too much to cover. So they're always going to try and figure out better ways to do it than selling to cover. Okay, some more bullet points here. Transaction costs in custody accounts are paid by you, the participant, so you have to pay for transaction fees. During the holding period, shares must remain in the custody account, and once any amount of the shares exceed the 4-year holding period, those shares can then be transferred to another custodian, such as Schwab, Fidelity, TD Ameritrade, and so on. If you're wondering why someone might do that, probably the biggest reason would be an employee might want to obtain more control and management convenience versus having statements coming from everywhere, 1099s coming from different places. So consolidation might be one big reason. And then, again, I mentioned that transaction costs are paid for by the employee. Oftentimes when you move it to different custodians, some of those custodians, like at our office, we pay for those transaction fees. The client doesn't pay for anything. Shares held at other custodians are also subject to trading windows, and what that means is, remember, this is called no trading periods. So it's the responsibility of the participant. So it's your responsibility as the employee, the executive, to abide by all trading restrictions. Truth be told, because they're technically managed by the employee, most people don't even know when the windows are. So we have to keep that in mind. If you have specific questions about this, please let me know, and I'd be happy to have a longer discussion about how this works. But bottom line is, whenever there's a trading window, these no trading periods or times when you cannot sell the stock, and even if it's held at a different custodian, so even if you've transferred it to a new custodian and you're in a no trading period, you're not supposed to sell the stock during that time period. If you leave the company, so we're talking about leaving the company with SMS now, so share matching. If you leave the company voluntarily, you must sell, easy for me to say, you must sell or transfer your vested shares within 6 months of departure. Matching shares are forfeited if you quit or get fired prior to the end of the holding period. Quick pausing moment here, unless it's for operational causes, and I should have put that in quotes, in which case shares are potentially awarded. So that operational causes can mean a lot of things. It can mean restructuring, it can mean downsizing, who knows? It doesn't really matter. The point is, apparently there are situations in which shares could potentially still be awarded, but again, this is an unofficial note. Bottom line is, what you need to understand is that if you quit or get fired prior to the end of the holding period, then matching shares are, on paper, they are supposed to be forfeited. If you retire, on the other hand, rights to matching shares are not affected, so you still retain those. In the United States, retirement age is the same for both SMS and PSP, so if you remember from the calculation earlier, it's your combined age and years of service much equals 65, and if you're 65, it doesn't really matter how many years of service you have. When you retire, all shares that still fall within the holding period are still subject to holding period rules, regardless of separation of service from the employer. So if you retire, you're basically just along for the ride, as long as if you were still working. So here's an example. If you're 65 and you've got 3 years left in your holding period, then you just have to wait till 68 years of age, after which your shares could be matched, and then you could liquidate them or transfer them, of course, keeping in mind tax planning as well. Upon termination of employment, any shares and dividends would be delivered to the formerly employed individual at the end of the holding period. And this pertains to both investment shares and any dividends earned on those shares. Now, speaking of dividends, dividends are reinvested into any shares purchased within the holding period. They're reinvested into new shares. The dividends reinvested in new shares show up on the statement as new shares purchased with those same dividends. In other words, there's going to be a separate line for dividends paid in each year. If the executive employee in question has shares that have already completed the holding period, when dividends are paid to those shares, they are paid in cash via Equate Plus into the employee's bank on file. So repeat that one more time. If you've already completed the holding period and dividends are paid, then you're going to get cash instead of shares. Dividends are almost always allocated in May, emphasis on almost always, so keep that in mind. It's not going to be exactly the same. And then in just another pausing moment here, for any dividends paid and reinvested within the final year of the holding period, if those shares are sold within 1 year, they would be subject to capital gains, short-term capital gains. So in other words, they would be subject to your income tax, not preferential tax treatment. So we want to keep that in mind when we're implementing some tax planning. Remember, it's first in, first out, FIFO accounting. So for the shares that have been paid within that year, we might want to hold them for a longer period of time in order to keep from paying as much in tax. What about if somebody passes away? Obviously terrible, horribly unfortunate if this were to happen, but for the surviving spouse or for the surviving family members, we want to understand what would happen and know the rules. So in the case of death or long-term disability, which also qualifies, DHL would determine what's called fair terms in which matching shares would be distributed. And this is again for the SMS. Typically, DHL provides the matching shares and just pays them out. However, this is what they call a course of conduct discussion, and it doesn't happen very often, but on the rare occasion that it has happened, they have paid them out in the past. So this is basically, again, unofficial notes. This is what we understand. So this is what you should believe to be true in the case that something, heaven forbid, were to happen to you or a family member that works at DHL. In the case of death or disability, shares will be delivered to the beneficiary or beneficiaries within 60 days. And then if there's any question as to the legal right of the beneficiary, the employer may deliver the shares to the deceased individual's estate. So it will be probated, go through the estate planning process. This is in situations where if you don't have a beneficiary on your account, if they can't find the beneficiary for any reason, if the beneficiary in your account has predeceased you, so if your beneficiary passes away and then you pass away after that because you didn't change the beneficiary, these are situations where it would have to go through your estate and then it would have to be probated. So I put a pausing moment here again. This is one of the many reasons it's so important to have an updated estate plan. So this is a will, healthcare directive, powers of attorney, financial language within your power of attorney, and for those that are applicable, a trust, living trust, AB trust, things like that. All right, so that concludes our tutorial for now. And when I say for now, what I mean is that we will be reaching out to DHL each year to check on potential updates. And if this tutorial needs to be updated, we'll record a new one and make it available to those who are interested in watching the new version. Speaking of those who may be interested, please feel free to share this video with your colleagues. As the saying goes, if you have a question, chances are there's a lot of others who have the same question. So my point is, there are a lot of people at DHL who don't understand this benefits plan, but they need to. And I would argue that at least 90% of people don't understand this plan because, again, I reiterate, in my 21 years as a financial professional, I've never seen one more complicated. So if you have any additional questions about this DHL plan, please feel free to reach out via email at info@libertaswealth.com, and we'd be happy to help. If you have questions related to your personal financial situation, or if you'd like to get a second opinion on your retirement planning, investment management, and estate planning, either email us or head over to our website at libertaswealth.com. A little blue window will pop up at the bottom of the screen as you scroll around, and all you need to do is click the button that says click here to get started, and once you go through that process, someone from my office will reach out to schedule a phone call at a time that's convenient for you. All right, well, I hope this was valuable and that it helped to make your executive benefits package a little bit easier to understand. We're here for you if you need us. Otherwise, we'll see you next time.